Today, we're presenting our company analysis on Nissan. To start, Nissan is a global automaker that was founded in 1933 and is headquartered in Japan. They produce a wide range of vehicles, including cars, SUVs, trucks, and electric vehicles. Nissan also operates manufacturing plants all over the world, including Japan, United States, Mexico, the UK, Spain, Thailand, and India. Over the years, they've become known for being an early leader in the electric vehicles, especially with the Nissan Leaf, and they continue to expand their EV lineup today. Next, let's look at Nissan's current strategy. One of their main approaches is broad differentiation strategy, which means they try to stand out through technology. This includes features like the ProPilot Assist, advanced safety systems, and EV innovations. They also use best cost provider strategy, offering strong features at competitive prices in popular models like the Rogue or Altima. Another part of their strategy is focused differentiation, especially in the EV. Nissan was one of the first major companies to push electric vehicles, and the Leaf helped them target buyers early on. Finally, they use an alliance-driven cost strategy, which helps them reduce expenses by sharing platforms and research across their global partnerships. Moving on to the strategic action, Nissan uses both offensive and defensive strategies. Offensively, they focus on technology leapfrogging, meaning they try to stay ahead by innovating in EVs, battery technology, and connected vehicles. They also update their model frequently to stay in the competition. In terms of timing, Nissan was the first mover in electric vehicles, but is more of a fast follower when it comes to automotive's driving technology. Their scope of operations is very broad, and they offer a wide range of products and have manufacturing locations around the world. Now let's talk about Nissan's international strategy. They compete globally to access large markets like the US, China, and Europe. Competing worldwide has also helped them lower costs through global scale and shared production. They benefit from access to lower cost labor and suppliers, and they can transfer their EV and tech expertise across different regions. Nissan uses a transnational strategy, which means they think globally but act locally. For example, they use global platforms but customize certain models for specific markets, like the Rogue for the US and the Note for Japan. The global advantages comes from locating product where costs are lower and coordinating operations across countries to speed up innovations.
As we're evaluating Nissan's strategic position as a whole, the key takeaway is that the company is operating in a very highly competitive, high capital intensive industry where external pressures are increasing rapidly. However, Nissan's internal financial condition is limiting exactly how effectively it can respond to these external pressures. Starting off strong with our strengths, Nissan's core advantage lies in its global scale and operational foundation. The company's well-established manufacturing footprint and supply chain allows it to produce at a high volume and compete on cost, which is in such an industry with such high fixed costs, this level of scale is extremely critical to maintaining efficiency. Nissan is also benefiting from its early investment in electric vehicles because it already has this established EV technology and production experience. It's positioning Nissan ahead of some late entrants into the industry as the entire automotive industry is shifting towards electrification. Another key strength is going to be this alliance. This alliance is allowing Nissan to share development costs, especially in a lot of those EV platforms of technology, which is helping to reduce the financial burden of innovation in such a capital intensive industry, which, as we'll see later, is going to be really vital for Nissan. In addition, Nissan is maintaining a broad product portfolio, which is helping it compete in different markets and kind of diversify its revenue streams. And finally, Nissan has strengths such as driver assistant technology like ProPilot that ensures Nissan remains competitive in safety and automation, even if it's not necessarily leading the market in these areas. Next, we're going to shift us to our weaknesses, which are going to be primarily financial and structural. The most critical issue is extremely weak profitability. With operating margins near break even, Nissan is lacking the financial strength needed to reinvest aggressively or respond to this competitive pressure, these external competitive pressures. The company is also relying very heavily on incentives to drive sales, which is reflecting a very weak pricing power. Where in a market where consumers have many alternatives, Nissan is often competing on price rather than differentiation, which is directly eroding these margins that they should really try to increase over the next few years. Nissan has struggled in key markets such as the US and Europe, where the competition is especially intense. So, combined with high leverage, this is limiting the financial flexibility and it's increasing Nissan's risk. So, overall, Nissan's weaknesses highlight a key issue. The company absolutely has the capabilities to compete, but not the financial performance to fully capitalize on them. Next, we're going to look at the opportunities where the most significant is going to be the global shift toward electric vehicles and sustainability. As was mentioned in the strengths, Nissan had early EV leadership and established technology that where they already had investments into these electric cars. So this is going to be a really big opportunity for Nissan to capitalize on in the years to come to kind of get ahead of any potential competitors. The company has the opportunity to scale more efficiently in this way as well. If Nissan can expand its capabilities in this area, it definitely has the potential to improve differentiation and move towards those higher margin offerings. On the threat side, the environment remains extremely challenging. Competition is intense, with pressure coming from both traditional automakers and newer EV-focused companies. This level of rivalry creates constant pricing pressure. Buyer power is also high, which forces companies like Nissan to rely on incentives to remain competitive. At the same time, supplier power is increasing, particularly for critical inputs such as those semiconductors and batteries, which is raising our costs and is creating a huge supply chain risk. We also have rising material costs, such as for that lithium and steel, that's going to be a threat. And in addition, we have a lot of regulatory requirements related to emission safety and data privacy that are continuing to increase cost and complexity. So, because vehicles are discretionary purchases, economic downturns can also quickly reduce demand and increase volatility. So, overall, Nissan is facing pressure from both the cost side and the revenue side at the same time, which is not creating a super optimal environment for the company to try and operate in. In conclusion, Nissan's position is defined by a gap between capability and performance. The company has the scale, technology, and partnerships needed to compete, but its financial weakness limits how effectively it can respond to in such a highly competitive environment with such rapidly evolving industry. Next, I'm going to turn it over to Ashley to discuss Nissan's strategic concerns.
Today, I'm going to talk about the three main strategic concerns we found from the SWOT analysis. These are the biggest issues the company needs to focus on moving forward. The first concern is fixing their profitability. Right now, the company is barely making any money and they rely heavily on discounts and incentives just to sell cars. That hurts their profits even more. They also have a cost structure that isn't very efficient, which makes it harder for them to invest in new technology or improve their products. So, improving their costs and finding ways to stop depending on discounts are really important for getting their finances back on track. The second concern is staying competitive in the global EV market. The electric vehicle industry is growing fast, and there are a lot of strong competitors like Tesla, Toyota, GM, Volkswagen, and the newer Chinese EV companies. Even though this company was an earlier leader in EVs, the other companies are catching up quickly. To keep up, they need to use their EV experience and continue improving their technology so they can stand out from the competition. The third concern is improving performance in key markets, especially the US and Europe. These are really important regions, but the company has been struggling there. Weak sales in these areas make it harder for the companies to grow and stay competitive. They may need to adjust their strategy, rethink their product lineup, and make changes to how they operate in those markets to get better results. Overall, these three concerns show that the company needs to improve its financial health, stay competitive in the EV space and strengthen its performance in major markets so they can grow in the future.
Based on our SWOT analysis and strategic concerns, we've developed 2 recommendations for Nissan. Our first recommendation is a traditional recommendation focused on simplifying the lineup and restoring profitability. This recommendation comes from one of the biggest problems in our analysis. Nissan has strong capabilities, but weak financial performance. The company has global scale, EV experience, and strong partnerships, but is still struggling with weak profitability, pricing pressure, and heavy use on incentives. To address this, Nissan should cut lower performing models, reduce unnecessary complexity in its lineup, and it should focus more on the vehicles and markets that generate the strongest returns. Nissan should also work more with its partners to share cost, technology, and development so it can improve efficiency. This goal of recommendation is to help Nissan improve margins, reduce waste, and turn its existing strengths into better financial results. This is the traditional recommendation because it's realistic, lower risk, and likely to help the company move forward in a practical way. Now, the second recommendation is the moonshot recommendation, which is for Nissan to become the Alliance affordable EV leader. This idea builds on Nissan's early EV experience and growing opportunity in electric and technology-driven vehicles. Instead of competing in a general way, Nissan could take a clear position by focusing on affordable EVs with such strong technology and connectivity features. To do this, Nissan could lead with development of affordable EVs across its alliance network and create vehicles that are practical, modern, and appealing to the mass market buyers. This would help Nissan stand out in a high competitive market and build a strong long-term identity. This recommendation is more risky because it would require investment in strong execution, but it also has a much higher potential payoff. If successful, it could help Nissan close the gap between what is capable and what they're currently achieving. Together, these recommendations give Nissan both a practical path to improve performance now and a bigger long-term direction for the future. Thank you for your time.